Picture a Tuesday evening in a middle-class subdivision, garage doors humming open one after another like a synchronized swim team of exhaustion. Inside one house, a family is signing electronic paperwork on a tablet at the kitchen table. A home equity line of credit, just approved, just in time to cover the kids' summer camp and a used minivan. 3 doors down, another family is doing something that looks almost identical on the surface, sitting at their own kitchen table, staring at their own laptop, except they are quietly declining a special financing offer on a new sectional sofa, choosing instead to wait 4 more months and pay cash. Same neighborhood, same income bracket, same well-meaning intentions. Neither family is reckless. Neither family is financially illiterate. Both of them love their kids. Both of them work hard, and both of them, if you asked, would say they're just trying to keep up. But one household is renting their future to pay for their present, and the other is doing something almost nobody around them is doing anymore. Saying no. Here's the uncomfortable truth nobody in the personal finance industry wants to say out loud. Most financial ruin doesn't arrive through some dramatic, headline-worthy disaster. It arrives quietly, one convenient purchase at a time, through products specifically engineered to feel harmless in the moment and catastrophic in aggregate. None of these products announce themselves as dangerous. They arrive dressed as solutions, as flexibility, as protection, as a small treat you've earned, and that disguise is exactly what makes them so effective. Millionaires aren't wealthy because they avoid spending money. They're wealthy in large part because they've identified 14 specific financial products the middle class buys into again and again, and they simply refuse. This isn't a list about willpower, and it isn't a list about deprivation. It's a list about recognizing the exact moment a purchase quietly stops being a purchase and starts being a long-term liability, wearing a short-term disguise today. We're walking through exactly what those 14 things are, the hidden mechanics that make each one so quietly devastating, and what wealthy households do instead. Let's get into it. Number 1. Using a home equity line of credit as an emergency ATM. A HELOC on its own is not evil. It's a tool, but somewhere along the way, it got marketed less like a financial instrument and more like a magic reserve tank sitting beneath your house, ready to be tapped whenever life gets expensive. The problem? Every dollar you pull out is secured against your home. Miss enough payments, and the lender doesn't just hurt your credit score, they can take the house. Data from the Federal Reserve shows the average variable HELOC rate has hovered well above 8% in recent years, meaning families are financing groceries, vacations, and car repairs at credit card level interest, collateralized by the roof over their heads. And because the rate floats with the broader market, the payment on that same balance can climb significantly within a single year, with no warning and no negotiation, simply because a central bank meeting went a certain way. Wealthy households use home equity strategically for value-adding investments, not as a substitute for an emergency fund. The quietly rich keep 3 to 6 months of expenses in cash, specifically so they never have to make that call. It's a boring, unglamorous habit, a cash cushion sitting in a savings account, earning modest interest, doing nothing exciting at all, right up until the moment it quietly saves someone's house. Number 2. Timeshares. Few financial products have a worse return on regret ratio. The average timeshare buyer spends over $20,000 up front, plus annual maintenance fees that climb every single year, regardless of whether they ever set foot in the property again. And here's the cruelest part. Timeshares are notoriously difficult to resell. Many owners eventually try to give them away for free just to escape the maintenance fees, and still can't find a taker. Entire online forums exist purely for desperate timeshare owners, begging strangers to simply take the deed off their hands. Millionaires don't buy the illusion of guaranteed vacation ownership. They simply book the trip, paying full retail on their own schedule for a single week, with zero maintenance fees following them home. Number 3. Extended warranties on everything. Walk out of any electronics store, appliance retailer, or car dealership today, and you'll be asked sometimes twice whether you'd like to add protection. Industry data consistently shows extended warranties are among the highest margin products retailers sell, precisely because most items never fail within the covered window, and even when they do, the repair cost is often less than the warranty itself. Wealthy consumers self-insure. They keep a small buffer of savings and simply accept the occasional repair bill, rather than prepaying a stranger year after year to protect against something that statistically probably won't happen. Multiply that decision across a washing machine, a laptop, a television, and a car over a single decade, and the money saved by simply declining the pitch is often enough to cover the rare item that actually does break, with plenty left over. Number 4. Buy now, pay later on everyday purchases. What started as a checkout option for the occasional big-ticket item has quietly metastasized into something people use for groceries, concert tickets, even fast food. The danger isn't the individual 4-payment plan, it's the invisible sacking effect. A 2025 Consumer Financial Protection Bureau report found that a growing share of BNPL users are juggling multiple simultaneous loans across different apps, with no single lender able to see the full picture of what they actually owe. Millionaires ask one blunt question before any purchase: can I pay for this today in full? If the answer is no, the purchase waits. Not because they can't technically qualify for the plan, but because they refuse to let a checkout algorithm decide how many financial obligations they're allowed to be juggling at once. Number 5. Rent to own furniture and electronics. On the surface, it looks like an accessible path to nice things without the upfront cost. In practice, a $600 living room set can end up costing $1,800 or more once every installment is added up, sometimes with the buyer losing the item entirely after a single missed payment, having built no equity at all. Wealthy households buy used, buy slowly, or simply wait, rather than paying nearly triple retail for the privilege of monthly installments. They understand a simple, almost inconvenient truth. A slightly uncomfortable living room for 4 months is a far better trade than 3 years of payments on a sofa you never actually owned. Number 6. Store credit cards for that instant 10% off today. That first purchase discount feels like free money, but store cards routinely carry interest rates north of 30%, some of the highest in the entire consumer lending market, and they're specifically designed to be opened impulsively at the register in a moment of excitement. Millionaires almost never carry retail branded cards. They use 1 or 2 low-fee cards, pay the balance in full every month, and let the 10% discount go because they've already run the math on what a single missed payment period would cost, and the math never, ever favors the register offer. Number 7. Overdraft protection as a budgeting tool. For too many households, overdraft coverage isn't a rare safety net, it's a monthly recurring event. Banks collected billions in overdraft fees last year alone, often $35 at a time, frequently triggered by purchases under $10. Wealthy individuals don't budget by watching their balance hit zero. They automate transfers, track spending proactively, and treat an overdraft fee the way most people treat a parking ticket. A rare, avoidable mistake, not a routine cost of living. There's a specific kind of financial exhaustion that comes from budgeting reactively, watching an app for red numbers, and the quietly wealthy have simply engineered that stress out of their lives entirely. Number 8. Earned wage access and payday advance apps. Marketed as a modern, friendly alternative to predatory payday lending, many of these apps still function on the same underlying model, a small tip or fee for early access to money you've already earned, which, when annualized, frequently works out to triple-digit effective interest rates. If you need next week's paycheck this week every week, that's not a cash flow hack. That's a structural income problem the app is quietly profiting from. The quietly wealthy build a buffer specifically, so they never need tomorrow's money today. It's the same principle as the emergency fund, applied one level earlier, solving the cash flow gap before it ever becomes urgent enough to reach for an app at all. Number 9. Private school tuition without a funding plan. This one is delicate because the intention behind it is almost always love, but financing $20,000 or $30,000 a year in tuition through loans or credit without a corresponding increase in income or a dedicated savings strategy quietly cannibalizes retirement contributions for years at a time. Wealthy families who choose private education fund it from cash flow or dedicated savings vehicles established years in advance, not from debt that competes directly with their own financial future. They ask a harder question up front. If this tuition requires borrowing, is it actually affordable, or does it simply feel non-negotiable in the moment? Number 10. Financing a wedding. The average American wedding now costs well over $30,000, and a significant share of that is financed through personal loans, credit cards, or wedding loan products marketed specifically for the occasion. Paying interest for years on champagne and flower arrangements that lasted a single afternoon is one of the purest examples of borrowing against your future to fund a moment instead of a life. Wealthy couples tend to spend dramatically less relative to their income on the wedding itself because they understand the marriage is the investment, not the event. The photographs last forever. The loan, unfortunately, lasts nearly as long. Number 11. Emotional home renovations. Not all renovations are wasteful. Some genuinely add value, but a huge share of home improvement spending happens reactively, triggered by a bad day, a neighbor's new kitchen, or a home makeover show, and financed on the spot with a contractor's in-house lending partner at rates far above a traditional loan. Wealthy homeowners plan renovations years ahead, save specifically for them, and separate the emotional impulse from the financial decision, usually by simply waiting 30 days before signing anything. Most of the time, the urgency quietly evaporates on its own, and the kitchen turns out to be perfectly fine after all. Number 12. Premium subscription box markups. Curated boxes for razors, snacks, clothing, coffee, vitamins. Nearly every category now has a $30 to $60 a month discovery subscription attached to it, quietly billing on autopilot long after the novelty fades. Individually, each one feels small. Stacked together, the average household with multiple subscription boxes is bleeding hundreds of dollars a year. For convenience, they could replicate manually for a fraction of the cost. The wealthy audit recurring charges ruthlessly on a fixed schedule, specifically because they know convenience fees compound just as relentlessly as interest does. A single 15-minute review once a quarter is often the highest hourly return on any financial activity a household will do all year. Number 13. Co-signing loans for adult children without a hard boundary. This one is rooted in love too, and that's exactly what makes it dangerous. Co-signing means the debt shows up on your credit, your liability, your risk, regardless of who makes the payments. If a child stumbles, so does the parent's own financial foundation, often at the exact moment they can least afford it, approaching retirement. Wealthy parents who help their children financially tend to do it through direct gifts within their means, or clearly bounded written agreements, never through open-ended co-signed debt. Love doesn't require unlimited financial exposure. Sometimes the most generous thing a parent can do is say no to the cosign and yes to a smaller, safer gift instead. And number 14, lottery tickets and scratch-offs as a wealth strategy. Americans spend over $100 billion a year on lottery tickets, more than they spend combined on movies, video games, and music put together. Research consistently shows lower-income households spend a disproportionately higher share of their income on lottery play, chasing odds that are, in most major jackpots, worse than 1 in 100 million. Millionaires don't build wealth by buying a dream for $2 at the gas station counter. They build it by removing chance from the equation entirely, one deliberate decision at a time, trading the dream of instant, improbable wealth for the far less thrilling, far more reliable mechanics of consistent, boring, compounding progress. So here's the pattern hiding underneath all 14 of these. Every single one of them offers something today: convenience, comfort, a discount, and escape of feeling, in exchange for a cost that arrives later, quieter, and larger than advertised. None of them are illegal. None of them are even necessarily irrational in isolation. A single HELOC draw, one extended warranty, one BNPL plan. None of that sinks a household on its own. But stacked together, purchase after purchase, year after year, they form the invisible architecture of a household that earns well and somehow never gets ahead. And here's what makes this list so much more dangerous than an obviously reckless purchase: a sports car, a boat, a shopping spree. Every single item on this list arrives disguised as responsible. A warranty feels like protection. A HELOC feels like planning ahead. A cosign feels like love. That's precisely why the middle class keeps falling for these 14 things while barely noticing it's happening, because none of them ever feel like the mistake they eventually turn out to be. The wealthy aren't smarter than everyone else. They don't have access to secret information the rest of us don't. They've simply learned to ask one uncomfortable question before nearly every purchase: is this decision solving a problem or just postponing one at a markup? That single question, asked consistently over a decade, is worth more than almost any investment return you could chase, because it protects the capital that would have otherwise been chasing that return in the first place. So take an honest look at your own recurring charges, your own financing agreements, your own quiet monthly bleed. Pull up your bank statement right now today and actually read it line by line instead of skimming the balance. Which of these 14 are hiding in your life at this very moment? And more importantly, what would it actually take this week to finally say no to just one of them? If this video helped you see your spending differently, make sure to like it and subscribe for more breakdowns like this one.